Everything has a life cycle. You're born and you die, and as you get older, you can see certain things that are symptoms of being later on in life. The reason why this is so concerning is because there are other countries in the world like China which are producing more value. What's up everybody, I'm Jaspreet Singh, and there's been a lot of talk about this changing world order. It's a theory by Ray Dalio where he says that the United States and the United States dollar is in decline, and so we could see a change in the world order sometime in our lifetimes. So what I want to do today is go over some of the principles that you need to understand when it comes to dealing with a changing world order. So let's jump right into it. Ray Dalio is one of the most successful hedge fund managers in history, and he has a pretty scary outlook on the United States economy. First, he says that capitalism is going to have to change because we're facing a crisis in our economy, and he says that the United States is suffering. He says, quote, that the United States is a 75-year-old empire and it's exhibiting signs of decline. And because the United States is declining, he thinks that's going to hurt the value of our dollars. He says, quote, that within the next 5 years, you could see a situation in which foreigners who have been lending money to the United States won't want to. So Ray Dalio is the founder of Bridgewater Associates, which is one of the most successful hedge funds in history, and his hedge fund is what made him a billionaire. I'm a fan of Ray Dalio. I've read his books, I read his articles, and one of the things that I really like about him is that when he makes his investment decisions, he doesn't just look at what trends are going on right now. He makes his investment decisions and really all of his decisions based on historical data. And so him and his company will look back hundreds of years and they will look at thousands of data points to analyze what's going on right now based on what has happened in the past, because although history might not repeat itself, it does rhyme. His philosophy when it comes to investing is to look at the data, and that's what has made him so successful, because he will look back hundreds of years and look at so many different data points to predict what's going to come next. And that historical research is why he is so worried about the future of the United States and our economy. So in this video, I'm going to be going over two different interviews that he had. One with MarketWatch back in September 2020, and the other with Business Insider that he did in February 2021. There's a lot of good information in here, and I'm going to talk about what he thinks is going on and what he says you can do right now to protect your finances. Ray Dalio says that life in the United States could become much more difficult in the future if our economy continues the way we are now, and this is going to cause three different things. First, massive debt. All this debt that we have in our country is going to stunt our future economic growth, and that is going to cause less opportunities for people. So the United States used to be the land of opportunity, and it still kind of is right now, but he predicts that that is going to change in the future because one of the reasons is this massive debt, which is going to slow our economic growth. So people are not going to look at the United States as the land of opportunity. And he also says that there's going to be a lack of trust in the United States dollar because of all the money printing, because of all the debt. And this is going to hurt the value of our dollars, which is going to lower our standard of living, because right now, the United States dollar is the world's currency. It is very strong and very powerful. And if the trust in the US dollar starts to drop, then our dollars are not going to stretch as far, and people are not going to be able to afford the same standard of living with the amount of dollars that they have right now. He's saying that the United States needs to make systemic repairs to provide greater opportunity for more Americans to achieve personal growth and financial security. And if the United States does not do that quickly, he says that the consequences will be painful. What's really interesting is he says that a big change that needs to be made in the United States is how capitalism works. And this is interesting because capitalism and this capitalistic system is what made Ray Dalio so successful. But he says that capitalism needs to change in the future if we want to continue being an economic superpower, because capitalists and capitalism are able to grow the pie. They're able to create more wealth, but they don't distribute the wealth very well. And so he says that there needs to be a new system where there is a way to create more wealth, but there has to be a way to get more of this wealth into the hands of more Americans. The problems that he says are going to give the United States the most economic issues over the next 5 to 10 years are, according to him, number one, the money and credit cycle problem. I'm going to talk more about this. Second, a wealth and values gap problem. And third, an emerging great power challenging the existing dominant power problem, which means China is getting too much power, they're getting too strong, and their economy might pass ours. Over the last couple decades, we have been losing our competitive advantages against the rest of the world. What he says is, first, our education system sucks. What he's saying is that we've lost a lot of our education advantages relative to the rest of the world, and our share of the world's GDP, so our share of the wealth relative to the rest of the world, has been reduced, and the wealth gap in our country has increased, causing more political and social problems. And because of that, we're not spending our time in this country producing productive growth. Instead, we're just trying to figure out how we can live with one another peacefully. However, we still do have some competitive advantages. He says that, for one, innovation and technology is still strongest in the United States, but China is coming back strong with innovation and technology. That's why TikTok was such a major issue in the United States. If you remember, TikTok was created in China, and Donald Trump did not want TikTok to be happening in the United States unless TikTok was sold to the United States. Why? Because the United States is worried about China and their innovation and technology growth, because that's one of the biggest advantages that the United States has right now. So we don't want to lose that to China. Our second advantage over the rest of the world is our military power, but according to Ray Dalio, the United States is still the strongest, but China has been coming on very strong and is coming close. And the third advantage that we have is the United States dollar, because our United States dollar is still very strong and it is still the world's currency. However, his concern is we're printing a lot of money and we're taking on a lot of debt, which is hurting the value of our dollar, and at the same time, we're also very late in our long-term debt cycle. If you're not sure what I mean by the long-term debt cycle, I already made a video explaining how our economic system works and what the long-term debt cycle is, and you can watch that video in the description below. So now if we jump in back to the top, the money and credit issue, because if you look at anyone's finances, your finances, my finances, any person's finances, if you have too much debt, if you have too much credit card debt, if you have too many cars, if you have too many things and too much credit, then this can stunt your growth, because now all your money is going out to pay your debt. Same with the business. If you start a business and you have way too much debt and you're not making enough money to pay off your debt, that is going to slow the growth of your business and it could kill your business. The issue that Ray Dalio says is many people understand how money and credit affect our personal finances and our business finances, but we don't see how money printing and debt affect a country's finances. In the interview, Ray Dalio compared the United States to the Dutch Empire and the British Empire, because they were very strong empires, but they came crumbling down because, one, they had created too much debt and money printing. They had lost educational advantages to the rest of the world. They had greater internal wealth conflicts, meaning a wealth divide. And then he said that there was greater challenges from rival countries. Does that sound familiar? Ray Dalio calls these four things: the money printing and debt, the educational losses, the internal conflicts, and challenges from other countries. Right now we're facing China. He calls these four things diseases, and he says they almost always play out the same way. And that's why he says that the British pound is no longer a reserve currency. He says everything has a life cycle. You're born and you die, and as you get older, you can see certain things that are symptoms of being later on in life. And he says that the United States is a 75-year-old empire, and it is now exhibiting signs of a decline. But if you want to extend your life, there are clear things that you can do. That means if we want to stay the world superpower, there are things that we can do, but these are things that you may not want to do because they're not easy to do. And one of the things that you can do, which he says is very clear, is you have to do a pretty big debt restructuring. The United States between 2020 and 2021 printed trillions of dollars and took on trillions of dollars of national debt to get our economy back going after the pandemic and recession. And this money printing, while it gave people stimulus checks and while it gave businesses bailouts for the short term, they're going to have long-term consequences. And that's one of the things that Ray Dalio is really worried about, because we're already really late in our debt cycle. We're already becoming an older country and an older kind of economic system. And that is the last thing that we need if we want to continue living as the world's superpower economically. And so one of the things that you have to do if you want to reduce your national debt is cut the spending and start living off of money instead of just credit. Because debt cannot create wealth. You have to have real productivity to create more wealth. But right now, all this wealth that's being created is just through cheap and easy debt. And so if we want to kind of reduce the debt that we have, we need to start getting rid of some of our expenses, pay down the debt, and that might even mean raise some of the taxes so we have more revenue. But from what it seems that Ray Dalio is saying, you have to balance that with less spending, and the government is not very good at cutting costs. They tend to raise taxes and raise expenses. The reason why this is so important is because right now our United States dollar is being challenged as the world's currency. And if that's the case, what he's saying is over the next 5 years, you could see a situation where foreigners who have been lending money to the United States won't want to, and the dollar will not be readily accepted for making purchases in the world as it is now. He says, look at the United States like an investment. If you were to invest your money in a person or a company, what are you going to look at? You're going to look at their income statement and their balance sheet. And so if a company you want to invest in is making more money than they're spending, then this might be a good investment. But the United States right now is spending more money than they're making. So you have your revenue right here and you have your expenses, which are bigger than your revenue. And if this continues like this, then he's saying that people are not going to want to continue investing their money into the United States because they're going to see that the United States is a risky investment. They're spending more money than they make, and they keep increasing their expenses, and they're not doing anything about the income. And this is going to cause a long-term issue because people will not want to put their money into the United States, and that could also hurt our economic growth in the future. The way you fix that, according to Ray Dalio, is by increasing productivity and equal opportunity. Because right now, we have so many people that are busy fighting for their cause. You have a lot of people that feel like they're left out in the economy. So many people that feel like they're left out in the country. And because of that, our productivity as a country is dropping. And so because so many people do not feel like they fit in, we have a lot of people that are not producing for the economy. And so it goes hand in hand. Yes, there are social justice issues. And these social justice issues are now causing issues in the long-term health of our economy. There's a lot of division in the United States from financial issues like the Occupy Wall Street movement we saw happen, and then social issues with the Black Lives Matter movement and the Asian hate issue that's going on. And so there's a lot of issues, and this is causing a divide in the country, and that is not good socially, and is also not good economically. The United States is one big team, economically and socially, and when a team does not get along, a team can't win. I mean, think of it like a football team. If the quarterback does not get along with the receiver, then the quarterback's not going to want to throw the ball to the receiver. Now you only have a running game, and you can't win a game if you only have a running game because the defense is going to know how to stop you every single play. So we have deep issues here on the money and credit side of things, which is also being fueled by the issues here on the wealth and value gap side of things, because we have all the social issues and we also have wealth division issues. Going deeper into the wealth gap that we have now, Ray Dalio says that capitalism and capitalists are good at increasing and producing productivity to increase the size of the economic pie, but they're not good at dividing the economic opportunity pie. Socialists are generally not good at increasing productivity and the size of the economic pie, but they're better at dividing the pie. So what he says is we have too much emphasis right now on distributing wealth and getting it from producing debt and printing money, and not enough from actually increasing productivity, because wealth, pay attention to this, wealth cannot be created by creating debt and money. Again, it goes back to that same kind of team principle. If people don't feel like they're on the same team, they're not going to want to work together. He goes deeper into this inequality issue on the Business Insider article. I have that here. And he says that America's jarring inequality is a, quote, national emergency. And he says that inequality as a tipping point. And this is going to fuel more hate, more antagonism. And so he's really worried about that, not just socially, because nobody wants to live in a world where they don't feel accepted, but also economically, because this is going to hurt the strength of our economy. And this could hurt the strength of the United States as a world superpower. A lot of the social issues that we have right now are tied to financial issues, and the solution, according to Ray Dalio, is that capitalism needs to change. He's saying that the system that made him a billionaire cannot continue the way it is. Essentially, he's advocating for a way to continue growing the economic pie through some sort of economic capitalistic system, but also have a way for people that are underserved to have an opportunity to earn a bigger piece of the pie. Now I'm jumping back to this MarketWatch article. Essentially, he's saying that the key here is this pie, this piece of the pie has to be earned from people through equal opportunity, because you cannot create wealth through debt and money printing. Because a lot of the things that we've seen happen in 2020 and 2021 to help distribute wealth was through money printing. Things like stimulus checks, things like bailouts to help continue fueling the economy. But he says that's not a way that you can build any wealth. wealth has to be created through production and through creating value. It cannot be created by just printing money, because that's a cost that we're all going to have to pay in the future through all the issues that I've been talking about. And how do you encourage more production and value creation? Well, this goes back to education reform, because like I said earlier, the United States education system sucks relative to the other world superpowers. And so something has to be done with their education system to encourage people to create more value, to go out and become entrepreneurs, to create things, to create more value and do more things, because at the current rate, we are not going to be able to sustain our economy and sustain our kind of world economic superpower the way it is, according to Ray Dalio. Now, before we get into number 3 and the things that Ray Dalio says you need to be doing with your money right now, I do want to mention that if you are interested in learning more about money management and investing, our team put together an amazing PDF that walks you through how to do that. This PDF is completely free when you sign up for our daily newsletter. So if you want to download the PDF, I got the link to how you can do that in the description below. I'm back on the Business Insider interview for this one, and he says that there is a quote, Thucydides trap. He said that this is the historical pattern of conflict that comes up when an emerging player threatens a global power. In this case, China challenging the US, and he says, quote, I've watched the story play out, and is playing according to the script, and it's very difficult to imagine a cohesive resolution of that story. Now, if you're like me and you're not sure what a Thucydides trap is, don't worry, I got the definition for you right here, and if I'm pronouncing it wrong, I'm sorry. The term Thucydides trap is based on a quote by the ancient Athenian historian and military general Thucydides, and he said back during the Peloponnesian War that a war between Athens and Sparta was inevitable because of the Spartan fears of the growth of the Athenian power. So because the power in Athens was rising, a war between Sparta and Athens was inevitable. So when we're talking about a Thucydides trap, now we're talking about a tendency towards war or conflict between an emerging power which is threatening an existing power. Now, as a little disclaimer, I'm not saying this is what's going to happen, and Ray Dalio is also not saying that there's going to be a war. What he's saying is this is an issue that we need to pay attention to, because right now, according to Ray Dalio, we have a lack of trust in the United States dollar, and this trust is going down because of all the money printing and all the debt. Now, in addition to that, we have the United States losing some of their competitive advantages. So we are ahead in innovation and technology, we're ahead in the military, but China's coming very close. At the same time, we're losing our spot, and we've already lost our spot as the leading educational country in the world. We are already losing our share of the world's GDP, and the wealth gap within our country is getting bigger, and all these things coming together with the Chinese economy growing is an issue that Ray Dalio wants us and the country to pay attention to. So now at this point, what do you do? Lucky for us, Ray Dalio has 3 recommendations on what you can do right now with your money. So let me clean off the whiteboard and put it up here. The first thing that Ray Dalio says that you need to do is stop hoarding cash. This is me paraphrasing what he said. What he actually said was worry as much about the value of your money as you worry about the value of your investments. He says that the printing of all this money that we have should make you worried about the value of our dollar, which is why asset prices have gone up. Stocks, real estate, gold, all these things have gone up because of all the money printing. And then he says that you do not want to own the thing that you think is safest. Cash. In other words, he's calling cash a liability. So you want to have cash for your savings, right? You want to have cash for an emergency, but after that, you don't want to just hold on to cash just to hold on to it. He wants you to convert your cash into other assets, things that will grow in value, because he's worried that the value of your cash is going to drop because of all this money printing and because of all this debt. The second thing that he wants you to do is to diversify your assets. Now, so you're going to take your cash and you're going to put it into assets, but he doesn't want you to put all of your cash into one asset because he wants you to be prepared for anything, and the way he says you should diversify is pretty interesting. He says you want to diversify not just in assets, so not just stock market and real estate and gold, but he wants you to diversify in different assets, different currencies, maybe that means cryptocurrency, but also different countries as well. The whole reason behind this diversification, according to him, is because he says that wealth isn't really destroyed, it just shifts, because when something goes down, something else goes up. And so you want to make sure that you have your money in different baskets, different types of diversification. That way when something's going down, something else should relatively be going up. And he says that you should be worried about the value of your cash. And the third solution, which wasn't really a solution that he said, it was just something that he kind of mentioned towards the end of his interview, is that you need to understand the value of things, because in the United States, we have a tendency to value things based on dollars. You look at gold and we value gold based on the value of dollars. We look at cryptocurrency, we value it based on dollars. We look at real estate and we value it based on dollars. And he says that we need to stop doing that, because there's an issue or potential long-term issue with the value of our dollars, because when people don't have money, like what we saw happen during the 2020 and 2021 recession, the government just prints more of it. And when you print money, no one really feels the immediate cost of that because the government doesn't have to take this money from anyone. They just print it. And so we can print more money, but eventually this is going to come up to a cost that we have to pay. And when the government has to take money from people like you and me, to pay this cost, that's going to be much harder to do because nobody wants to give their money away. And so there's a cost to all this money printing. And so you have to understand that when more money is printed, the value of our dollars get diluted. So you do not want to just keep valuing everything based on dollars, because he says that the value of our dollars are going to drop because of our lack of production relative to the amount of money printing that we're doing. We're going to jump back into the video in just a second, but before we do, if you're an investor and you're looking to get better returns on your money, I can help you. I've been investing my money for over a decade now, and what I've learned is that the number one way to make more money on your investments is by actually investing your money and then by learning from your mistakes. But this can be very time consuming and very expensive. That's why the second best thing that you can do is by learning from other successful investors. Learn from their successes and learn from their mistakes. That's why I created Market Insiders, which is an investing education app where you'll get access to top level successful investors in the real estate, stock market, and cryptocurrency space. Every week, you'll get access to group coaching calls where you'll learn how to be a better stock market, real estate, and cryptocurrency investor. So if this sounds like something that would be beneficial to you and your investment portfolio, I'll put the link to where you can try out Market Insiders for free with a 10-day free trial in the description below. There's no surprise that some people are concerned about our economy, the stock market, and inflation. I mean, billionaires have been issuing warnings about the economy for years now.
I want to get your take on this. How are we doing as an economy right now?
The scientific financial term is we're screwed.
And the only person more bearish than Robert Kiyosaki is none other than Ray Dalio, who has started one of the most successful hedge funds in history, Bridgewater. His hedge fund manages more than $140 billion, which is more than any other hedge fund in the world, so he knows a thing or two about investing. And Bridgewater recently put out their 2022 Global Outlook report where they go over inflation, they go over the economy, and they go over what they think is coming. And essentially what they say is investors are not prepared for what's actually coming. I spent a number of hours reading through this report and watching interviews and reading accompanying documents. That way I understand what they're talking about. And what I want to do today is break it down and make sure it's simple to understand, because there are some complex topics in here that the average person might not understand. For example, the title is the 2022 Global Outlook, the successes and excesses resulting from MP3 policies. And MP3 isn't a song that you listen to, it's monetary policy 3. So let's break this down. The whole thesis of this report is that what investors are expecting to happen in the economy and inflation are wrong. So what he says is that investors, for one, expect inflation to cool down. Right now, we're seeing inflation as something around 7% annually. And he says that investors are expecting inflation to come down to 2.5%. Not at the end of 2022, not at the end of 2023, not at the end of 2024, but at the end of a decade. So investors have predicted and priced into the markets that inflation is going to come down to 2.5% after a decade, which is pretty different from what the Fed keeps saying. But he says that investors don't believe the Fed anymore, and they think inflation is going to come down to 2.5% over the course of a decade. Then he says that investors believe that the Federal Reserve Bank is going to stop raising interest rates once the Fed brings interest rates up to 2.25% to 2.5%. Right now, interest rates are at 0%, and so the Fed says that they want to raise interest rates to fight inflation, and investors think that they will go up to 2.25% to 2.5%, which is quite a bit higher than where it is now. And the Bridgewater report says essentially that you are dead wrong. Inflation is going to be worse than what people expect, and the Fed is going to have to take much more drastic action, even though they don't think it yet. So the report breaks it down by creating this formula. It says that money plus credit plus income equals spending plus financial asset purchases plus reserves. Now, this might be a little daunting at first, but to understand this, you have to understand how the economy works. The way that Ray Dalio and Bridgewater like to break it down is that the economy runs on spending. The more money you spend, the more money somebody else makes. If you have $100 in your pocket, it's not doing anything for the economy. It's helping to build your savings, but it doesn't help grow the economy. But now, if you take this $100 bill and you go to a restaurant and you spend it, Well, now the restaurant owner just made $100. They can take your $100 plus a lot of other people's money to go out and open another restaurant and hire more employees. So in order for the economy to function, people need to spend their money, and the more money that you spend, the more money that somebody else is going to make. But in order for this system to work, people need an income, because if you don't have an income, you don't have money to spend. And that's what we saw happen in the 2020 pandemic. People stopped working, people weren't able to work, and so people didn't have an income stream coming in, so they weren't producing anything. But that's when the government came out and they started printing money and they started giving it to people. So you weren't producing anything, but people still had money to spend. So you were buying things even though there was nothing being produced. So if I diagram this out, the government worked with the Federal Reserve Bank to print more money. Then this money was injected into the economy, which increased the amount of credit in the system, and it increased people's incomes. You weren't working, but you were still making money. Now that people had money in their pocket, they were able to now spend. People got their stimulus checks and they went out to the Gucci store, they went out to Louis Vuitton, they went out to Amazon, they went out to Kroger. They were spending money that was given to them through the help of the government. And some people also took this new money and they use it to buy financial assets. They put this money in the stock market, they started investing their money. So we saw people get money, they started to pay down their debt, they invested the money, and some of them spent the money. This system that the report talks about is now creating a self-perpetuating flywheel. Remember what I said before, the economy runs on spending. The more money you spend, the more money somebody else makes. So when the government printed this free money, it gave people incomes, they started spending it, which meant that now spending increased. If more people are spending money, that means that other people are making more money. So this more spending then created higher incomes. So now people started seeing these higher incomes, even if it was nominally, they started seeing these higher incomes, and then they went and they started spending even more money. You see how I started to create this system, this spinning system, kind of like a flywheel or a spiral where you're making more money, so you spend more money. And now that you're spending more money, other people are making more money, which means that people are spending more money, which means people are making more money. And so this started creating this self-perpetuating flywheel. I changed the colors a little bit, that way you can see the different steps. So the first thing that happened was the government created money, and then people got this money in their pockets. Now people got this money and they started spending some of this money. They spent less than half of the money that they got, and then they invested some of this money, they saved some of this money, and they used some of this money to pay down their debts. And so the money that they spent then increased people's wages, because now some people were making more money. So it drove up incomes. Now people were making more money, so what did they do with this higher income? Well, they went out and they started spending this money even more. Then what this did is it started creating an even bigger credit system, because now that people were making more money, they're able to qualify for bigger credit cards. They're able to qualify for bigger loans. They're able to qualify for bigger mortgages. And this created a bigger credit system, which then means more money entering the system. So you start to see this. So you now have more credit in the system, which means now more people are spending more money. At first glance, this might seem completely normal. You make money from your job, so you go out and spend some of it. And so now businesses make money and the economy is growing, which means now you're going to be making even more money, which means you have more money to spend, and it creates a self-perpetuating flywheel. But the difference now is here. We still have a lot of free and cheap money that's being printed. We still have super cheap interest rates, which means more money keeps entering our economic circulation, which means people are going to have more money to spend. And as they have more money to spend, they're going to want more money. They're not just going to want more money because they want it, but also they need it and they feel like they deserve it. The cost of everything else around you is going up, so people are going to need more money. But the problem is, in order to sustainably support higher incomes, you also need sustainably higher productivity. So if we take this free money out of the equation, what does that leave us with? That means that people are now going to be earning money from their jobs, and they're only going to be able to spend based off of how much they earn or how much debt they can qualify for, because that's how our system works. You can spend not just based off how much you earn, but how much debt you can qualify for. So now you spend money based off of how much you earn, and now the economy can only grow based off of how much you spend. And if the economy grows, then you would be able to justify higher incomes, because you would be able to produce more money because it is being absorbed into the economic system. You are earning money and then you're buying things. And if our economy is able to produce more products, that means we're becoming more productive, which means then you'd be earning more money, which means you have more money to spend. So you're able to grow the economy stably because you're not relying on free money. But we don't have that system right now. We have people relying on their incomes, plus the credit that they can get from the banks, plus the free money that's being injected into our economic system, which means that people are able to buy more than what they're able to produce. In a general free market system, you'd like to see somebody's income go up relative to how productive they are. The more you produce, the more money you should make. The more value you provide, the more money you should make. But now we're entering a system in the economy where people need more money, not just because they can produce more value or not because they are producing more value, but just because they need more money in order to survive because the cost of this is getting so high. And this is the same reason why the financial assets, so stocks and real estate, have been becoming so expensive, because now people are earning more money. So some of this money is going here. People are able to qualify for more debt, and some of this money is going here. And you have a lot of free money entering our economic system, and some of this money is going here. All these things are making it harder for people to play in the game, to be able to afford things and to be able to afford assets, which is why people want to make more money, not because they're actually producing more value, which is where the real concern lies. Think about it this way. Imagine that I'm your employee, you're my boss, and my job is to take this marker and move it from my right hand to the left hand. You own a marker factory, you sell markers to people, but for some reason my job is to just move this marker back and forth, and I do this for 8 hours a day. And I come to you and I say, hey, you beautiful minority mindset viewer, can you give me a raise? You're paying me $40,000 a year right now. I want $45,000 a year. Now you're gonna look at me and say, well, you're not really producing anything for the company. Why should I pay you more money? Now, you wouldn't want to pay me any more money because I'm not producing you any extra value. So that's the system, and the problem that people are facing right now is people want more money, not because they're not producing any value, but they're producing a certain level of value right now, and now they're needing more money, not because they can produce more value or that they are producing more value, but because they just need more money in order to afford this and this. If you had a company and you had to hire a whole bunch of people like me to do this, you're not going to be in business very long because you're spending a whole bunch of money on unproductive things. And that's the concern, that if companies have to keep paying money for unproductive things, meaning they just have to pay more money just to pay more money on things that are not producing more value, well, that's very bad news for the economy and companies in general, because that means money is being spent on unproductive use. That's why Bridgewater says that the strong spending here, coupled with the inability to produce more value here, is leading to the highest potential for sustained high inflation in 40 years. What they say here is due to the strength of nominal spending, that's this right here, outpacing the capacity to produce, central banks and the Fed are now facing the greatest potential for a sustained rise in inflation in 40 years. And the reason why this is such a big issue now is because typically when we see this happen in a recession, then the Fed would just raise interest rates. They would tighten their monetary policy, which would remove this, which would get the system back running. But they're not able to do that right now. Essentially what it says is that the Fed is still worried about the state of the economy, and couple that with this pandemic that's still lingering around, which can still hurt the economy. And so we have an economy that is not fully running on its own yet. And the Fed is scared to raise interest rates because that could detrimentally affect the economy, because when you raise interest rates, it makes borrowing money more expensive, which can slow down the economy. And if the Fed slows down the economy, then we enter a recession. But if they don't do that, then that creates more inflation. So like I said in a previous video, the Fed has to pick its poison. Would you rather fight inflation or fight a slower economy? That's when they essentially hinted at saying that they don't think that the Fed will keep raising interest rates right away because they're not going to want to hurt the economy, which will ultimately make inflation even worse, which means you're going to see the price of things go even higher, while incomes are going to be needing to go higher, but people are not going to be able to get these higher wages because their productivity isn't going to be growing fast enough. The reason why that's so interesting is because the article says that while asset markets might be more sensitive to a rate rise than in the past, the real economy might actually be less sensitive to a tighter policy. The article goes over a few charts where it shows that average people, so lower to middle income people, are actually wealthier today than they were before because they have more cash in the bank and because they have more money stored in their homes and their home values are higher. So average people, lower to middle class people, are actually wealthier today than before, which is why raising interest rates won't actually affect the real economy as bad as it will affect asset markets like the stock market and the real estate market. And so what he's saying is the Fed still might not raise interest rates fast enough because they're worried more about the stock market and the real estate market than they're worried about the economy. All of these things put together essentially come down to two concerns for investors that Bridgewater wants you to be aware of. The two things, well, he says that you need to be aware of are, first, the risk is that if inflation continues to rise sustainably, there's a chance that we could see asset prices fall in terms of real value. And the second risk is that the Federal Reserve Bank doesn't do anything because they don't want to slow down the economy. And then this would force the Fed to then essentially play catch up with raising interest rates, which could make the problem a whole lot bigger. So starting here, if inflation keeps rising, how could that make the real value of assets go down? Well, you have to understand what inflation is. Inflation is when you have more dollars out there. And when you have more dollars out there, the value of each individual dollar goes down. So when people have more money, they're going to use this money to buy things that maybe aren't that productive and they're not really that valuable. So that's when you can see the real value of assets go down relative to the price, because you might see the price of a whole bunch of assets go up. You might be seeing people buy a whole bunch of worthless assets with their dollars just because they have a lot of dollars, and that can prop up the dollar value of these assets, but in real value, they might not actually have any value, or their value might actually drop even though their price is going up just because there's more inflation happening. So this can happen if the Fed takes a moderate stance on inflation and they try to do some interest rate hikes to help fight inflation, but they don't want to fight inflation super aggressively because they don't want to slow down the economy. But if the Fed is really worried about the economy and they essentially do nothing, well, that means we're going to continue to see inflation rise even more aggressively, and then we might or will hit a point where the Fed is going to say, uh-oh, it's a little bit too late now. Now we need to really start hiking interest rates, and that's when this whole issue is going to be a whole lot bigger, and it's going to take a whole lot longer to fix. Now, while this is important for you to understand as an investor, what Bridgewater says is if we zoom out a little bit more and we look at this from a global perspective, the reason why this is so concerning is because there are other countries in the world like China which are producing more value, which are creating more innovation, and this slowdown that we're seeing essentially gives China a path to surpass us as the strongest economy in the world. Essentially, China is facing opposite economic issues to us, where right now we are trying to fight high inflation and trying to get this sorted out, while China has low to moderate inflation because of what they did during this pandemic. And so now China has the ability to stimulate and help grow their economy faster, while we're trying to figure out how do we get inflation under control, which can help slow down the economy, while China is trying to ramp up their economy. This is why it pays to be financially educated and why it pays to have an actual real diversified portfolio. When most people talk about a diversified portfolio, they're talking about just owning a blue chip fund, a growth fund, and maybe an innovation fund in the stock market, but that really doesn't give you any real diversification, because if the stock market goes down, then your entire portfolio goes down. Real diversification means having money in different asset classes and in different asset types. That way you can benefit in any stage of the economy. That means you might have some money invested into emerging market ETFs. That way, if the United States is fighting high inflation and the rest of the world is growing, you can benefit there. Maybe you have some physical gold to help fight inflation. Maybe you have some innovation ETFs. That way, if the economy is growing super fast because we have super low interest rates, well, then these innovation companies grow. Maybe you have some real physical real estate. That way you have some tangible assets that can produce you some cash flow. This is why you need to be financially educated and have a real diversified portfolio. That way you can take advantage of whatever's happening around you. In 2021, if you had some extra cash laying around and you kept it in the bank, or in this case, you could have even kept it under your mattress or put it in a drawer, you would have gotten the same return. But if you kept your cash in savings, in cash, you would have gotten a 0% return on your savings, because banks are paying you essentially nothing on your savings in the bank. But the good news is wages did go up in 2021. In 2021, wages went up by 4%, but unfortunately, wages did not keep up with inflation, because according to the CPI reports, which we all know are kind of massage numbers, but the CPI numbers said that inflation went up by 7% in 2021. Now, this looks bad, but you have to look at the other asset classes as well, because real estate in 2021 went up by around 19%, while at the same time, the NASDAQ, so these are typically the tech-heavy stocks, the NASDAQ is an index, the NASDAQ went up by around 21% in 2021, and at the same time, the S&P 500, which is an index, a group of the 500 biggest companies in the stock market, the S&P 500 in 2021 went up by 27%. This means if you were like the majority of people and you're not financially educated, you kept your cash in savings, you kept your cash in the bank, you were a loser. Not just to inflation, but to everything else, because now if you want to go out and invest in the S&P 500, well, it is more expensive now than it was a year ago. If you want to go out and buy a home, it is more expensive now than it was a year ago. And if you want to go out and buy groceries, well, it's more expensive now than it was a year ago. And guess what? Your wages are not keeping up. The reason we saw such high inflation, not just in the prices of things, but also in assets, was because of the Federal Reserve Bank. In 2020 and 2021, the Federal Reserve Bank opened up the money printer and they slashed interest rates, which created an influx of more dollars into our economic circulation, which caused more inflation. Inflation is when we have more dollars, which causes the value of each individual dollar that you have, so your savings and your earnings, to go down, which makes the price of everything else, your groceries, your real estate, your stocks, to go up. In the early part of 2021, when people started to get worried about inflation, the Federal Reserve Bank reassured everyone that inflation is just transitory, it's temporary, so you don't have to worry about it. That way they could continue the money printing and continue ramping up inflation. The Fed wanted more inflation. They made that very public. Now, I'm not saying that the Fed wanted more inflation just to make things more dramatic and make things more interesting. That's actually what the Federal Reserve Bank said when they created their monetary policies to have low interest rates and free money flooding the markets. They said that they wanted more inflation. Forbes covered it. The chairman of the Federal Reserve Bank said that their monetary policies had the goal of increasing inflation. That was their goal. Well, in the end of 2021, that's when the Fed started to realize that they were wrong. They saw that inflation was a problem, and they finally admitted that the inflation that we were seeing was not transitory. Up until that point, the Fed somehow thought that it was a good idea to keep ramping up inflation through low interest rates and free money being injected into our markets to help grow the economy. But then they realized that it was too much. Some people have said that this inflation move by the Fed is the worst call in the history of the Federal Reserve Bank, which is saying quite a lot because the Federal Reserve Bank also said that we did not have any sort of housing bubble before the 2008 crash, and they also said that we had no dot-com bubble before the 2000 dot-com bubble bursting. Now here we are in 2022, and we're really starting to pay the price for all of the Fed's monetary policies. We're paying the price for all this inflation. When you go to Chipotle, you got to pay more money for that extra guac, but we're also paying the price in the asset classes because we're seeing a lot of volatility in the stock market. Hedge funds are selling some of their stocks at record speeds, and now we have a lot of people predicting a downturn in the stock market because now the Federal Reserve Bank is going to have to reverse their policies to make up for their mistakes, and so people are worried about what's going to happen in the stock market. Just so we're on the same page, let's go over the Federal Reserve Bank's goals, because the Fed is the secret little entity that has the ability to control your money because they're in charge of our monetary supply. So what the Fed does is they look at our economy, and when the economy is booming, what they do is they want to cool it down. The way they do that is by increasing interest rates, and what that does is it decreases inflation because they want to lower the monetary supply. When we are in a bust, when we are in a recession, then what they want to do is the opposite. That's when they want to cut interest rates, and that in turn increases inflation. So when you have low interest rates like we've been seeing, then more people are likely to go out and borrow money. More people are likely to go out and get a mortgage. More businesses are likely to go out and borrow money because it's cheap. And so when you have these low interest rates, more people are borrowing money. When more people are borrowing money, you have more dollars entering our economy. When you have more dollars entering our economy, you have more dollars floating around, which makes each individual dollar that you have less valuable. That's why your earnings don't stretch as far, your paycheck can't buy you as much, and your savings don't feel as strong because, well, they can't buy you as much. On the flip side, when you're in a booming economy, a fast-growing economy, the Fed wants to make sure that it doesn't get out of hand to prevent bubbles. We all know how well that happens, but they want to prevent these sort of massive bubbles. So what they try to do is when you're in a very fast-growing economy, they try to raise interest rates, which then makes it more expensive for you to borrow money. It makes it more expensive for you to go out and buy a home. It makes it more expensive for businesses to borrow money, which is supposed to help cool down the economy to prevent the economy from overheating, and this will also lower inflation because if less people are now able to borrow money, there's less dollars entering our economy, which means less dollars, less inflation. You really have to be able to understand this if you want to understand why what the Fed is doing right now is so important, because we're in a very strange economy. When the 2008 crash happened, the Fed had the ability to cut interest rates, which helped to increase inflation, which allowed the economy to recover, at least on paper, because we weren't worried about inflation issues before the 2008 crash happened. So the 2008 crash happened, we entered a bust, we entered a recession, and the Fed slashed interest rates, which made it easier for people to borrow money, which made it easier for businesses to borrow money, which allowed them to increase inflation to help get the economy up and running. We're in a very different situation now because we're already fighting high inflation. We already have low interest rates, and now we might be going back into a secondary recession. This is what the Fed is worried about. Our United States economy right now is not growing as fast as the Federal Reserve Bank would like, and it's actually slowing down, which is opposite of what the Fed was hoping for. CNBC reported about how our economy is slowing down, and it's not just the United States. Yeah, world economies like China that are seeing their economy start to slow down. So now, if you are in an environment where the economy is slowing down, you'd like to see lower interest rates. At least the Fed would like to see lower interest rates. That way, you can help grow the economy faster. But the Fed actually wants to raise interest rates because that's the only way that they can fight inflation. See, the issue that the Fed and the economy are facing right now is the Fed's policies over the last couple of years, which included low interest rates and lots of money printing, which contributed to high inflation, is actually pushing us towards another recession. This super high inflation now is stopping people from being able to afford things. So consumer spending is going down, which means businesses are making less money, which means now we're going towards another recession because our economy is slowing down. But at the same time, we have such high inflation that the Fed has no other option except to raise interest rates. And if you remember what I said just a few minutes ago, what does raising interest rates do? Well, it cools down the economy. It slows down the economy. And so if we're already in a slowing economy where the Fed has to slow down the economy even more, well, now that becomes a big issue for the Fed, the economy, and the markets. The dilemma that the Federal Reserve Bank is facing right now is you can't fight a recession created by inflation by creating more inflation, because that is the tool that the Federal Reserve Bank has to fight a recession. Back before the 2008 crash, we weren't worried about inflation. There wasn't an inflation crisis going on. That's why when the bubble burst in 2008, the Federal Reserve Bank had the ability to then lower interest rates, create more inflation, and help spur the economy. Now, we're already worried about inflation, and now the Fed is having to fight inflation, which is going to cause the economy to slow down even more, which would then create even more economic slowdowns. This is why you're starting to see a lot more volatility in the stock market, because investors are starting to come to terms with the idea that inflation is, one, not transitory, and the Fed is going to have to do something to fight this inflation. And so now if it becomes more expensive to borrow money, well, you don't want to have your money kept up in a company that isn't making any money, because now these companies that are relying on debt, that are trying to grow quickly without any real profits, are gonna be paying more money in order to grow. I mean, just think about it practically. If you could go out and borrow $10 million and you only have to pay 3% a year on the $10 million, well, if you can take $10 million, put it in your bank account and put it into your business, and you can grow this $10 million by, say, 5%, you just became profitable. All you had to do was grow your money by more than 3% a year, and now you were gonna come out profitably. So it wasn't that hard to see growth when money is so cheap. But the problem with this cheap money is then it causes more inflation. It makes the price of everything go up. And so this is why the Fed now wants to raise interest rates, because they want to start fighting inflation, which then means that businesses that want to borrow money are going to have to pay more money. So if you cannot sustainably grow your business without borrowing super cheap money, well, it's going to become harder and more expensive for you to grow. On the economic side, smaller growth means less employees that are working and smaller profits. On the investing side, that's why you're seeing a lot of investors move their money out of the fast growth and momentum stocks, which are heavily relying on cheap debt, into more companies that have cash, that have profits, that have the ability to grow without the need of super cheap debt. Now, we don't know for sure how much the Federal Reserve Bank wants to raise interest rates yet. Everybody has a guess. Like Goldman Sachs says that the Federal Reserve Bank wants to raise interest rates 4 times in 2022, but nobody really knows. It's going to be up to the Fed, and it's going to be dependent on what inflation looks like in 2022. Because in 2021, the Fed kept saying that the only reason why we're seeing inflation is due to supply chain issues. This pandemic screwed up the supply chain. You have people that are not working overseas. You have all the shipping issues. And because of that, that's why prices of things are going up. Now the Federal Reserve Bank is admitting that it's not just because of supply chain issues, it's also because of all the money printing. And because of that, we're going to see real inflation. But they're also saying that they believe, the Federal Reserve Bank believes, that inflation will cool down by the end of 2022. The Fed believes that inflation will come down to 2% by the end of 2022. Remember, inflation was 7% in 2021, and they believe it's going to come back down to 2% by the end of 2022. Now, if the Fed is wrong, I'm going to say that one more time. If the Fed is wrong, then they're going to reassess their monetary policy, which means they're going to hike up interest rates even more. If that happens, then it might be a shocker to some investors or to the markets, because the people that are trusting the Federal Reserve Bank are hoping that they will not have to do that. But if they have to do that, well, then that means borrowing money will then become more expensive, and that would then slow down the economy even more. Now, to be fair, you do have some people and economists that are of the belief that raising interest rates will not slow down the economy, that we have an economy right now that is so robust, that is so strong, that raising interest rates can't slow it down. Now, my job here as a random guy on YouTube is not to get you to like me or to tell you what to believe. It's to educate you. That way you can make smarter decisions with your money. So let me just diagram this out. That way you can understand and make the decision for yourself as to how rising interest rates would affect the economy. Let's assume that you want to go out and buy this home, and in order to do that, you would have to borrow $400,000. Well, if you could go out and borrow $400,000 and get a mortgage at 3%, it's going to cost you just a little bit under $1,700. If I could get my numbers right, you have $1,700. But if you had to pay 6% in interest on the same $400,000, now this exact same amount of money and home is going to cost you $2,400 a month. So it's going to cost you significantly more just because mortgage rates are higher. So when interest rates go up, it becomes more expensive to borrow money. Now, what do you think is going to happen? Do you think more people are going to go out and buy this home when it's more expensive, or are more people going to go out and buy it when it's cheaper? I mean, you can even think about how it works at your local mall. Do more people go shopping when things are on sale, when they're cheaper, or do more people go shopping when things are more expensive? Most of the time, people are going to spend more money when it's cheaper, because it's cheaper for you to go out and buy more things. Well, when things become more expensive, people can't spend as much and they don't buy as much. When people don't buy as much, the economy slows down because the economy relies on spending. The more money you spend, the more money somebody else makes. If you don't spend any money, then how is Chipotle going to make any money? If you don't go out and buy Apple AirPods, how is Apple going to make any money? If Apple isn't making any money, the corporation, well, then their profits are less. If their profits are less, then their stock isn't as valuable. If the stock isn't as valuable, then people don't want to pay as much money for the stock, which in turn pulls the stock price down. So does this mean that we are going to see a stock market crash in the near future? Well, it really just depends on how fast the Federal Reserve Bank has to raise interest rates. If the Fed starts to realize even more that this inflation is not transitory, that they need to do more things to cool this inflation down, then they will be forced to raise interest rates even faster. If they're forced to raise interest rates faster than expected, that will slow down the economy more than expected. If it slows down the economy more than expected and people spend less money than expected, well, then that would hurt the economy even more, which would in turn hurt the stock market even more. But of course, it isn't always so simple. I mean, you can't just look at interest rates as the sole factor to understand what's going to happen in the stock market. The stock market has a lot more factors influencing it than just interest rates. If the economists who say that raising interest rates will not slow down the economy are right, then it won't be as bad. Because yeah, we're raising interest rates, which will help cool down inflation, but at the same time, the economy doesn't slow down, which means companies continue to make record-breaking profits, then it's not so big of a deal. Because yeah, it's becoming more expensive to borrow money, it's becoming more expensive for businesses to borrow money, but the economy isn't slowing down, which means companies continue to make profits, which means people still have money to invest, which means people will continue to put their money into the market because they like the valuations of companies, which would continue to push the stock market up. And then, of course, you have something that I like to call the X factor, which are the government programs, which are really unpredictable. Now, if you would have asked me this 15 years ago, this would have been something that very few people would be predicting. But after what we saw happen in the 2020 pandemic, where the government created eviction moratoriums, where the government created foreclosure moratoriums, where the Federal Reserve Bank opened up the money printer and started unlimited quantitative easing, which means they opened up the money printer and said that they would put an unlimited amount of money into the markets to make investors confident to invest their money back into the stock market. That makes it a little bit harder to predict what's going to happen because the Federal Reserve Bank clearly does not want to see another stock market crash, which is why they created more inflation just to inflate the stock market. For the last number of months, they've been putting billions, hundreds of billions of dollars into the stock market, into the bond market, just to make investors confident to put their own money back into the markets. So the Federal Reserve Bank is willing to sacrifice the financial health for the average American just so investors can continue making profits. This is why it gets kind of hard to predict what's going to actually happen in the market. But our economy does have some red flags, especially as to what's coming, which is why I want to go over what I'm doing with my money right now. But before I get into that, two brief things. First, a quick disclaimer. You are never guaranteed to make money when you invest. You might even lose money, so always do your own due diligence and never blindly listen to a random guy on YouTube. I don't like the idea of just trying to time the market because what happens when an investor tries to time the market is when things are going down, you just keep saying, I'll wait until it goes a little bit lower. If it goes down 10 more percent, then I'll come in and buy. And what ends up happening for a lot of investors is you miss the bottom. You say, oh, it's going to go down a little bit more, then it starts to go up. And then when it starts to go up, you say, oh, this is just a little bounce. I want it to go back down lower. That's when I want to buy because now it's too expensive. And then it goes up even more. And now you say, oh man, I missed the bottom. Now it's too late for me to buy. It's too high. And then it goes up even more and you say, well, that's it. I guess I'm not buying. And then when it comes time for you to sell, it's the same thing. You get greedy. You want to time the top and then you say, I'll sell it when it goes up just another 8%. And then it goes up 2 more percent and you're like, just a little bit more. And then it starts to go down and you're like, oh, it's just a little bit of a dip. It's going to turn back up. And then it goes down more and you say, now I got to wait. I used to have big profits. I can't sell it for a small profit. And then it goes down more and now you're at a loss. And now you don't know what to do. And then it goes down even more. And now you're at a big loss. Now you start to panic. You feel bad. You had this big profit. And now you're selling at a big loss. Instead of trying to time the market like that, I have two different strategies. A passive strategy and an active strategy. My passive strategy is super simple. All I do is I have some ETFs that I want to own. These ETFs give me exposure to a few different things. I have some ETFs that give me exposure to the general stock market, the S&P 500. I have some ETFs that give me exposure to innovation and some of these growth companies. So it's a different sector, a different area of the stock market. And then I have some ETFs that give me exposure to emerging markets, kind of as my protection. So these are stocks outside of the United States. So every week I have money going into these ETFs, and this happens passively and automatically. I don't know if you can read this or not. And this will continue to happen every single week, no matter what's happening in the market, whether the market is up or down. So this is giving me exposure to the market, no matter what, and it's happening every single week. Then I have an active strategy where now I know some individual companies that I want to own. But I want to make sure that I'm coming in at a good price, that I'm not overpaying for them. So these are the companies that I'm watching. These are the companies that I'm studying. These are the companies that I'm reading the earnings calls. And when I see the price of these companies go down, that's when I come in and buy. And if they continue to go down, then I buy even more aggressively. And so as it comes down, that's when I buy. The further down it goes, the more aggressively I buy. If it doesn't come down, I don't buy. This is one of those things where I just want to make sure I have a good price. I don't want to come in and chase a stock. I don't want to come in and chase a company. I want to buy something that I believe is a good value. Now, what's a good value to me might not be a good value to you. This is why I don't give stock picks, because what's good for me might not be good for you. And what's good for my time horizon might not be your time horizon. Maybe you're buying for 6 months. Maybe you're buying for 2 years. I don't know. Depending on that, what investments you're investing in are going to be different than me, and my goals are going to be different than your goals. The things that you invest in are going to be different than the things that I invest in, and your risk tolerance is going to be different than mine. But what I'm trying to do here is, instead of trying to time the market, is I want to know what I buy, and if it comes down, that's when I buy. If it goes down more, that's when I buy even more aggressively. You have to pay attention to what's happening around you, and I hate the idea of trying to predict what's going to happen. Maybe the stock market will boom. Maybe the stock market will crash. Maybe the stock market will go sideways. I don't know. And I'm not going to wait to do anything until that happens, which is why I have a strategy. I know that every week some of my money is going to be invested, and I know if the stock market goes down and I see a good buying opportunity, I'll come in and buy. This is why a lot of wealthy people don't get worried about a stock market crash. They treat it like an opportunity to go in and buy, like Black Friday, because that's when investments go on sale. They're on discount. Every single time a market crashes, it doesn't matter which market crash we're talking about, two things happen. First, people are blindsided and they lose a lot of money. And second, people always start praying and hoping that this never happens again. Now, while history doesn't exactly repeat itself, it does rhyme. And so what you want to do is you want to be in a position where you're starting to prepare for the next market crash right now. That way you can not just survive, but thrive through the next market crash. Because the interesting thing about market crashes is you see more millionaires created out of market crashes than any other time. Look, I'm sorry to be the bearer of bad news, but the market will crash again. I have no idea when it's going to happen, and everybody has a prediction as to what's going to cause it, like all this quantitative easing, free money, high unemployment. But the market will crash, we don't know when, and so you need to be in a position where now you're preparing for it. That way you are ready, that way you can survive and thrive through the next market crash. My mind has to systematize things, which is why I love outlines so much, which is why if you want to know how to survive and thrive through the next market crash, there are 5 things that you need to understand and know, which is what I'm going to be going through in this video. I've always been kind of like a tough guy. I played football in high school and I try to lift every single day, but I also really like tulips. Tulips are my favorite flower because I like the way they look. But the interesting thing about tulips is they're also a symbol for financial education. Tulips are originally from Turkey. And when Turkish merchants brought tulips to the Netherlands, the Dutch fell in love. And tulips kind of became like this symbol of luxury because they were this really rare flower and obviously they're really beautiful. And then what happened is you saw people in the Netherlands start to buy tulips, not just because they're a nice flower, but because people wanted to own them as a status symbol. And so then people started to buy up the price of tulips, and you saw the price of tulips started to rise. Now the Dutch farmers and merchants were getting rich buying tulips because they would buy tulips one day, and then when they would go around to sell the tulips, they would be able to sell it for so much more because there were so many people that wanted to buy tulips and not enough tulips out there. Everybody wanted tulips in their garden because it was a real status symbol, and if you had tulips, it meant you were rich. And so now these farmers and merchants were getting so rich that the investors started to get excited. They thought, if the farmers and merchants can get rich by buying tulips, why can't we do it too? So then the investors started buying up tulips, not to sell them in the open market or to plant them, but because they saw them as a great investment. Now here's the thing, if you're an investor, you don't want to be the person going to auctions or growing tulips or doing any of that. You just want to be in the business of managing money. So the investors then started creating tulip derivatives. That way they didn't have to own or take care of these actual tulip bulbs. They could just trade these pieces of paper. So now investors started creating these tulip derivatives, and lots of people had the ability to now go out and buy tulips on paper because now you can invest in tulip bulbs. That's when tulip prices really started to skyrocket because now you had everybody trying to buy tulips, not to plant in the front yard, but so you could get rich because tulips were going up in price so fast. It got to the point where people were literally selling their houses or refinancing their houses. That way they could go out and buy one tulip bulb because tulip prices were going up so fast and everybody was getting rich buying tulips. Now you have tulip bulbs costing as much as a house, and you have these farmers and merchants sitting on all these tulip bulbs thinking, wow, we are rich. Let's sell some of these tulip bulbs. That way we can cash in on all of our profits. So the farmers held an auction to sell out their tulip bulbs, and guess what? No one showed up. Nobody actually wanted to buy the tulips, and nobody really wanted to pay that much money to own a tulip bulb. People were buying tulips not to own tulips, but just so they could get rich quick. When the farmers started to realize that, they had to cut the prices of the tulip bulbs significantly so somebody would actually buy it, and that's when the price of tulip bulbs crashed, and now everybody that had refinanced their homes or sold their homes to buy a tulip bulb were left holding nothing except a pretty flower. This is a true story. It was called Tulip Mania, and it happened in the mid-1600s, and this was the first recorded financial bubble in history. After that financial bubble, we've seen market crashes happen again and again and again, not with tulips, but with other assets, because people will always be greedy, people will always be looking for speculative investments, and people will always look for a way to get rich quick. When you have all three of these things that are fueled now by cheap and easy debt, that's how bubbles are created. And once a bubble hits a peak where now people are not willing to buy more of this thing, that's what causes the bubble to burst, and now you have a bubble boom and bust. That's why the first thing you gotta do if you wanna be able to survive or thrive through the next market crash is understand market crashes. So every asset class and our economy goes through cycles, kind of like this, where you have boom phases and bust phases, but over time, you see the overall kind of baseline of this thing go up. So if you're talking about the stock market, you see stock prices go up and down and up and down and up and down, but over time, you see the value of the stock market go up. When people talk about market crashes, the most common thing that they're talking about is the stock market, and you see these type of stock market booms and busts happen every 8 to 15 years or so. What happens is people start buying assets and the economy grows and companies grow, and then the price of these assets start to go up, and that's when the media comes out and they say that this asset price, the stock cannot stop growing and it's booming, and this gets more people excited. Then people start coming and buying more, and now the media gets even more excited talking about how everybody is getting rich, and now the speculators get so excited and everyone's talking about how they're getting rich, and so now people are going into debt talking about all these stocks and assets that they're buying, and now you're going on your Uber drive and your Uber driver's telling you about how they refinance their home, that way they can put their money in the market, and this causes asset prices to soar even more, and eventually you hit a breaking point where asset prices go up way too high, and once that happens, people stop buying the stock or they stop buying this asset, and this causes prices to cool down. Once things start to come down a little bit, now the media comes out and they talk about how everyone's losing money and how the stock is starting to struggle and how a lot of people are starting to sell, and this causes prices to come down even more. So now people start panicking because you had all these people buying these prices right before the top, and then things start to come down, especially if you're leveraged. Now you're really in the red, and so people start panic selling. This causes the media to come out talking about how everybody is losing money and why if you want to survive you have to sell everything now, and this causes prices to go down even more. And then you have people coming out thinking, wow, this price of this asset or the stock is really low. It's below what I think it's worth. And so now people start to come back in and they start to buy, and that's when you see the cycle start all over again. Warren Buffett has a great quote on this. He says that bubbles happen because people see their neighbor who is dumber than they are get rich, and so they want to buy in too. When you see a stock in the news talking about how the stock is starting to go up, you might be a little bit skeptical, but then you start to hear about all of your friends buying the stock and making all this money, and you're like, well, if they're making money, I might as well do it too. So that's when you come in and you buy, and you might not even know why you're buying it. You're just buying the stock because everybody else is doing it and it looks like it's going up, and so now you buy in, and then you might see the stock go up a little bit and you're thinking, wow, if I had just leveraged up my bet a little bit more, I would be able to make so much more money. So now you being the genius you are, you leverage up your bet through the help of margin or debt, and now you own all this stock, and you might not know why you're investing in it, but you're making money, and then eventually things get a little bit too hot, and that's when things correct, and now you're in the red, and now you're panic selling. That's why the very first thing you gotta do before you can do anything else is you gotta understand how the game works, because the majority of people are playing in this game, but they're playing on the losing side. They come in and they buy here out of greed, and then they panic and they sell here because they start to worry and they start to lose money. And so you gotta understand how the game works, that way you can win in the game. The second thing you gotta do is you gotta be prepared, because market crashes can happen at huge extremes. You can have like 2008 economic depressions, or you can have smaller economic crashes. The way you do that is just by preparing your own personal finances. That way you are ready for anything. First thing you gotta do is you gotta have an emergency savings fund. If the economy crashes and your company goes under and you don't have a job for a little while, you need to have some cash that you can fall back on, that way you're prepared. So you wanna have something like 3 to 6 months worth of expenses saved in a savings account that's there liquid, just in case something bad happens, that way you can fall back on that. Second thing you want to do is pay off some of your consumer debt. This might be your car or your credit card debt. If you have this consumer debt, this is debt on things that are not making you any money, pay it off. Once you lay your financial foundation, then you want to get a little bit on the offensive by diversifying your assets or having different income streams. That way, if something bad was to happen, you are not financially devastated. Maybe you have different income streams like real estate rental income and dividend income instead of just your job. That way, if something were to happen to your job, you do have some other income to fall back on. And you can have different types of assets. Maybe you have some stock assets. Maybe you have some hard assets. Maybe you have some cryptocurrency. That way, if things were to go bad, bad your money isn't tied up in just one asset class, because if you see the stock market crash, your other assets might be okay. But the interesting thing about diversification is when the majority of people talk about diversification, they're really not diversified at all. They say something like, yeah, I'm diversified. I got some of my money in blue chip stocks, and I got some emerging economy ETFs, and I got some growth ETFs, so I'm diversified. But all of your money is just within one asset class. It's all in stocks, paper assets. And so if the stock market crashes, all of your stocks, all of your funds go down. If we're talking about being really truly diversified, that means having your money in different asset classes, having some of your money in stocks, paper assets, having some hard assets like real estate, having some commodities like gold and silver, and now maybe even having some cryptocurrency. The whole point of this type of diversification is really to protect you from any type of scenario, because the next thing you gotta understand is 3, when the market crashes, you gotta remember your goal. The reason why you really gotta know your goal and your strategy, because one stock might be a great investment for one person, but that same stock might look like a losing investment to another person. And so if I came to you and I asked you, is Tesla a good investment? The answer is, it depends. What's your strategy? What's your goal? Are you a value investor, in which case you're looking for a beat up and undervalued company that you can buy and hold for the long term where the company turns around? If that's the case, then maybe not. But if you're a momentum trader and you're looking to make some money quickly, then this could be a great investment if you can come and buy and sell it and make money. If you are a long-term value investor and you're investing your money in the stock market for the long term because you want to build long-term wealth, and you come in and you buy here, and this investment that you buy comes down to here, then you don't want to be panic selling as long as you believe in the underlying value of your investment. The only thing that you want to do is come in and buy more. I'll talk more about that in just a minute, because you have a long-term horizon. You're not trying to buy and sell your stock in 6 months or a year, because you are trying to invest in this company or this ETF for the long term. But if you're a trader and you want to make money quickly and you buy here and you see the stock come here, then you got to have your risk parameters in. At what point do you sell? Because if you see your stock coming down, then you might want to just sell quickly, because you don't know, maybe the market is just correcting or maybe it's crashing, but you want to make sure you have your risk parameters in there, because you're trying to invest for the short term. And so if you come in and you're like, all right, I'm buying here and I want to be a long-term value investor and I believe in the underlying value of this company or this ETF, and then you start to see this company or this fund come down, and now 6 months later you're like, you know what, I'm just going to cash out right now, that way I can cut my losses. Well, now you're kind of switching sides. What is your strategy? Are you a trader, or are you a long-term value investor? Because if you still believe in the long-term value of this company, you're just not happy with the price, then you are switching sides. That's why you got to start by understanding your goal and knowing what your strategy is, because if you're investing for the long term, then you got to understand market crashes are a part of the game. And speaking over the long term, what we've seen happen time and time again is that over the long term, you see the US economy, strong companies, and the stock market continue to go up. Now, that doesn't mean that it always continually goes up in a straight line. We see it kind of go through these waves like this, but over the long term, the market corrects, and so do strong companies. And so you got to understand, if you are a long-term investor, all you got to do is ride it out. If anything, come in and buy more. That's why the fourth thing you got to understand is don't panic. If you come in and you buy the stock right here, let's assume you buy it for $100 a share, and then it goes up to here at $200 a share, and you don't sell it, it might look like you made $100, but you don't actually make any money until you sell your stock. So on paper, you made $100, but you haven't actually made any money. And then let's assume that the market crashes and the price of the stock comes down to $50. At this point, it looks like you have lost $50 because you put in $100 and now you're down 50%. But again, you don't actually lose any money until you sell. This is where you have to be able to manage your emotions. And it sounds silly, but the people that can manage their emotions can make the most money in the stock market, because now you're thinking financially, not emotionally. And when things come down, you remember your strategy and you remember why you bought. And so now you keep the long-term horizon in mind. Now look, sometimes this can be really hard, because when you own a share in a company and all you see is this company going lower and lower and lower and lower, you might think it's the end of the world. But one thing that you have to remember is that a company's stock is different than the actual company. And so you got to remember, if the company is doing okay, this is your research. So if you are a long-term investor, you have to be doing this research. If you see that this company is doing okay and they're still growing and they're able to grow and turn around, then this might be a company you want to continue holding on to. But you also don't want to just go down with the ship, because if this company goes bankrupt, you lose everything. So the first thing you got to do is you never want to invest more money than you can lose. That's why trading on margin has its own risks. So you got to first understand how much money you're putting in. Are you okay losing this money? Second is you got to understand your strategy. If you're a trader and you start losing money, you got to have your risk parameters. At what point do you sell? If you are a value investor, if you're investing for the long term, you got to understand what factors are you paying attention to. That way, if this company starts to go under, when are you going to sell? This is where the best thing that you can do is remember what your original goal was. Is a long-term investing or short-term trading, and make your decisions based off of the research on that. These 4 things that I just talked about are going to help you survive through a market crash better than the vast majority of people. Now, if you really want to thrive through a market crash, you got to come in at number 5, buy. When you see a market crash happen, it doesn't matter what asset class we're talking about, whether it's cryptocurrency or stocks or real estate. When you start to see these asset prices crash, the people that come in and they buy are the ones that come out as winners over the long term, because now you get to buy a great asset at a discounted price because everybody is panic selling, and this is when you want to come in and buy. But there's some tricky parts to this, because some people are trying to be traders, right? And if you're trying to trade and you have a short-term time span and you come in and buy here, well, 3 months later, the stock price might be there and now you're losing even more money. This is where you got to, again, understand your strategy and have your parameters in place. I like investing for the long term. So if the stock price is coming down here, I'm going to come in and buy. And then if it comes down here, I'm going to buy more. And if it comes here, I'm going to buy more. So I like to buy in phases. I call this drip investing, where when asset prices start to come down, I start buying. And as they come down more, I buy even more aggressively. There's a couple things that I do to make this happen. Now, before I tell you that, I do got to let you know that investing has risks. You are never guaranteed to make money when you invest. You might even lose money. So make sure you always do your own due diligence and never blindly listen to a random guy on YouTube. But the first thing I got to do is I got to keep some cash on the side ready to invest. And so you got to understand that cash is an investment position. Now, your cash is going to get eaten away by inflation, but I always have some cash ready to invest just in case. The second thing is, when it comes to this drip buying schedule, I like to buy in phases. And the way I do that is, first, I have my own list of investments that I want to own. So if we're talking about the stock market, I have a list of stocks and ETFs that I want to own. And these are things that I believe in, and I already done this research. Now, if these prices start to come down, that's when I start to buy. And as they go lower, I buy more aggressively. And so this might be every 10 to 15% the stock or ETF goes down. That's when I come in and I buy more aggressively. So I'm paying attention to when these prices come down, and when they do, that's when I buy. The lower they go, the more I buy. Market crashes are kind of like a Black Friday sale for investors, because you can come in and buy great assets at a discounted price. The thing that you got to remember is it is impossible to try to perfectly predict when the bottom is. So it's impossible to try to time the market. The people that tried to time the market during the 2020 market crash missed it, and then they saw a lot of people come in and buy, and they missed that rally. And so what you got to remember is it's impossible to try to time the market. And if you do try to time the market, it's like trying to catch a falling knife. And so it's impossible to know how far down it's going to go and how long it's going to take for the market to turn back around. And so if you are investing during this time, you got to have faith, and you got to remember it takes time and patience for things to turn around, because there's no way to predict when this rise is going to happen again. But the reason why you see so many millionaires born during a market crash is because this allows people to come in and buy a ton of assets at a discounted price. And then when things do turn around, now you have these asset owners who see the prices of their assets skyrocket, because now the economy is just turning around, and you have these people that are owning huge amounts of shares or assets because they were able to buy at a huge discount. End up becoming a money pit, because now every single month you're paying for upgrades, you're paying for repairs, you're paying for maintenance, and this is something you have to do with your home. What I tell people is, if you're serious about becoming wealthy, before you go out and buy a home to live in, go out and buy a rental property, because when you buy a rental property, you're going to buy it for one sole purpose: to make money.